Alright, so let's look at the performance appraisal part. So once you've looked at all the different kinds of alternate investments, real estate, commodities, private equity, hedge fund, what is each kind of investments and all, we also need to evaluate the returns, whether the returns of the alternate investment category is making sense. Should we invest into the alternate investments category or not? What kind of returns are they generating? Is it good enough? Is the return good enough given the kind of risk we are taking? Because obviously there are a lot of risks and all involved with respect to alternate investments. So now first of all we need to understand the additional risks that are there, and then I'll explain as to different return measures and what are the issues with those return measures because of these additional risks and all. We'll see. But I'm assuming that you understand Sharpe ratio. We've done a full lecture on that. I'm assuming you understand, you've done portfolio, Traynor ratio. Even if you don't, more or less you'll get it, but still, I mean that part is covered, and you've covered something called downside deviation in quants. So these three terms have already been covered because I'll be needing it in the next part when I talk about the ratios and all. Anyway, so let's start with this part first. This you won't have any problem here. So one, when you're looking at alternate investments, we've also seen the kind of heterogeneity between the different kinds of investment, like a real estate and a hedge fund and a private equity. They're also different within themselves. So maybe a lot of additional risks over here may not be applicable to on gold. These risks that we are going to talk about, like liquidity. Liquidity is not a problem with gold. Gold is a very, very liquid asset. You will be able to sell gold and fetch its fair value in a very short duration of time. But when it comes to real estate, it might become a problem. In REIT, it may not be so much of a problem when you're looking at a real estate investment trust, mutual fund of real estate. But the problem over there could be that maybe it is very volatile, like the equity market. So even within the real estate, how you are investing in real estate becomes important. Right. So in general, when you're looking at the additional risks and all caused by the alternate investments and all, let's see, one, the transparency is low. You can see listed stock prices of all the public entities and all, but be it private equity or be it real estate prices and all, you'll not be able to see. REIT prices you can see, but even the REIT is holding certain office buildings, premises, investments in real estate, which is generating that rental income, right? That valuation is not available. REIT's price is available, but the underlying assets within the REIT, prices of those are not available. So still there is a problem. There is an illiquidity aspect over here. There is a transparency aspect. You do not know the prices exactly. You do not know a lot of things. When, say for example, you buy a flat. Now once you enter into the flat, then you start knowing, okay, the construction quality is not that great. Okay, there is this problem in over here. There is that problem over here in this apartment and all. Or when you buy an office building, then you start figuring out, okay, there is this issue over here. There is this pollution issue over here I did not know about, or whatever. The transparency aspect is very low, asymmetry of information is very high, and there is less disclosure. You don't even have so much disclosures, right? Like for stock markets, listed stocks and all, you have a lot of disclosure. Like gold, you'll be able to see the prices and everything. But for most of the alternate investment category, you will not be able to see the pricing data, the accounting data, etc. because there is no norm for that kind of disclosure. Hedge funds do not have that kind of regulation to disclose data. So that is one problem created. Transparency, information available is low. Second is illiquidity. We've already understood that. You may not be able to sell the asset at its fair price in a short duration of time when you want to. So you might, in case you need, you're desperate for money, you have an immediate requirement for liquidity. In that case, you might be forced to sell the asset at lower than fair price in order to get money immediately. That is possible. Illiquidity is high, and that is the reason why we say that alternate investments ideally is supposed to provide you a high return. I know commodities might give you a lower return, but in general, alternate investments, of course, if you're going to be taking more risk, if liquidity is low, you should be getting a liquidity risk premium. You should be getting compensated for that extra liquidity risk that you're taking. My discount rate should be higher. I should be getting an extra return. Next is complexity. Obviously, when you're looking at valuation of a real estate or valuation of a private equity company, valuation of a venture capital where you do not even know how the company is, or it's an absolutely new kind of company, valuing a leveraged buyout or something wherein there's a huge amount of debt involved, a distressed company, valuing commodities is very difficult. You cannot do future cash flow method. So it is complex, and it depends on variety of factors. Agricultural commodities pricing might be based on weather factors, etc. So it is quite a bit non-traditional way of looking at things and valuing. So the complexity is of course there, and especially when you get into hedge funds and those strategies and all, the strategies could be very, very complex and very, very unusual, and that is why the market is relatively untapped. If I may not say untapped, but at least less than equity. I mean, if you see that way, inefficient, less efficient than the equity markets and all. Next, you use something called derivatives, forwards, futures, options, swaps. Derivatives is a full subject altogether which you separately study. So for those who have done derivatives, it amplifies both your risk and return. You can gain exposure. It's like betting. So without actually buying something, you can bet on their price movement. So I have to first spend the 100 rupees or I have to invest 100 rupees in order to bet on that 100 rupee worth of stock. But using derivatives, I may not need to invest that 100 rupees. I can just simply bet on it. So you'll have to do derivatives to understand this point. And the second one as well, when you're looking at mark to market, when you use derivatives, there is something called mark to market that is done. Mark to market. So you keep on you'll keep on have to post margins and all. So there is a lot of volatility. So the way the prices are moving, you'll have to keep on depositing margin and all accordingly. Mark to market is done, model calculation is done, and that increases your cash flow volatility. These 2 points you'll understand only once derivatives is complete, right? So that is mark to market for you. So you'll keep on doing your mark to market for the positions, for the futures, etc. You've taken in hedge funds. You use derivatives extensively in order to take positions, in order to take that kind of risk and that gain that kind of exposure. So mark to market. The moment you do mark to market, your cash flow volatility increases. Again, you use leverage. You can take loan. You're allowed to take loan. Mutual funds may not be able to, but hedge funds do. Leverage buyout. You take a huge amount of debt and then you take a public company private. Right, so when you're looking at the leverage aspect, the leverage is going to be maximizing not only profits but also losses. So there is a risk, the volatility increases again. Manager and its expertise. So selecting the correct manager is very important, and the manager's expertise to work in the market is very important. It happens that, say for example, when you're looking at a 2020, 21, 22 kind of a time frame, everybody is a very, very expert in stock market because everybody's made money because the markets have doubled. So everybody is very good. But when I look at a 5-year, 7-year horizon, 10-year horizon, then I will understand that which manager is good, which manager is bad. So just by looking at a couple of years worth of past returns, for a manager or something, it is very difficult to evaluate. It is very difficult to deduce that way. And finding the correct manager is very important, especially in alternate investment, because there is a certain amount of skill and expertise needed. The difference between the top and the bottom quartile manager is quite a bit significant in alternate investment. So therefore, the manager is very important, and its expertise, again, because the market is complex and the way the alternate investment market is very specialized. Like a hedge fund manager cannot do real estate, a real estate manager cannot do commodity. So it is very specialized. A lot of expertise is required, and whether you're able to find that correct skill in the market is becoming challenging. So that is one option, one risk: getting the correct manager, getting the correct investment. So manager's expertise is there to choose the correct investment, but you have to first select the correct manager. So that is adding on to the risk over here, right? And the last one is we are discussing is cash drag. Say for example, when you're looking at venture capital fund, you've invested into a private equity fund that invests into VC, venture capital. Now for the first 3 years, 4 years, you're continuously investing. Your cash flows are almost negative in the first couple of years, 2, 3 years, 4 years. And even when you make a VC investment, it takes a few years or a couple of years at least for the investment to start yielding return. The investment is going to be done, the business is going to move forward, it's going to expand and bulge, and then you'll be able to sell it to another investor, or do an IPO will take you maybe 5, 7 years, 8 years or so. So at the beginning, you're making investments, your cash flows are negative. It takes another couple of years, a few years in order for the investments to ripen, and then only after at least 5 years that the fund has started, that you start generating good amount of returns normally. So there is a cash drag. So for a longer period, you keep investing, and then you will be able to start deriving returns. It's not that I make an investment, a risky investment today, and tomorrow I'm able to liquidate and generate some return, or even day after tomorrow, as in 2 years or 3 years. Rather, there is a major cash drag. You keep on investing in the beginning years. And also again, you understand that there is a lot of cash flow volatility, because say for example, in a private equity fund, you end up committing $100 million. Let's say you committed personally $10 million. They have drawn down, or they have asked for a capital of 2 million. You don't know exactly when they'll ask for 3 million or 4 million next, a total of 10 million. You will have to be ready with your liquidity, because you've made that commitment that I will contribute this much capital. What if they find a good investor 3 years later? For 3 years, you're sitting on a pile of cash, and they will be asking for money much later. So in that 3-year period, you are keeping 7 million liquid, that I have given 3 million right now and yet to give 7 million right now. And when you have to give that 7 million, at that point for 3 years, they did not ask for the remaining 7 million. Obviously, you don't want them to make bad investments, quickly you do bad investments, I don't care. But for 3 million, you had to sit on 7 million liquid money. Obviously, you must have generated for those 3 years, you were not able to generate good return on 7 million. So these issues are going to be there, but you'll have to be patient. You'll have to look for the right opportunities to make investment into venture capital, into these kind of forms of investment. Be very patient. Instead of losing money, you're better off being patient. But then we have to acknowledge that there are issues with respect to cash drag. The P fund has taken your 7 million after 3 years, but for those 3 years you had to maintain liquidity. Na? You had to be prepared that whenever these guys ask, I'll have to pay 7 million because I made that kind of commitment, committed capital. So these things we'll have to understand. Next part is going to be your performance measures. So how do we evaluate the performance of these alternate investments? So we've got a few ratios that we are going to study, and then a couple of more measures that we are going to be looking at. Most of this portion you already know because you have done a very detailed understanding of these measures in other lectures. So Sharpe ratio, we've already done it earlier. Sharpe ratio is RP minus RF by sigma P. The return above risk-free rate, because even if you do not take risk, bank is going to give you RF. So the return that I've generated over and above RF, that divided by standard deviation is what I'm looking at. If I'm looking at the Sharpe ratio of only P fund, so P is return minus RF divided by P is risk. In that case, I'm not taking into consideration correlations and all. And see a few pointers you'll have to understand, which is going to be standard. One, just a second, I just want to make sure I've not missed out on anything. Alright, so basically when you're looking at Sharpe ratio, say for example I calculate the Sharpe ratio for P fund alone. I'm not looking at portfolio, as in I'm not calculating Sharpe ratio for equity, fixed income, P, hedge fund, etc. all together. I'm not calculating the Sharpe ratio for that. I'm calculating the Sharpe ratio only for P fund. So say for example the return of P fund divided by sigma of P fund. So when I'm looking at the Sharpe ratio, first I'm not even calculating the correlations and all. I'm not seeing how the Sharpe of P is related to the traditional investments and all, low correlations and all. Sharpe ratio is using standard deviation of the portfolio in the denominator. Standard deviation means we are assuming that the second order, standard deviation of second order, skewness is third and fourth is kurtosis, that we are assuming normal distribution. We are assuming that standard deviation is the correct measure of risk. Standard deviation is the only measure of risk. So I'm calculating the excess return earned per unit risk. For every 1 unit of sigma, for every 1 unit of standard deviation, what is the excess return generate? We do minus RF because RF, though obviously you'll be earning RF without taking risk. The return you generated above the RF is because of taking this risk, the standard deviation of the private equity fund or hedge fund or whatever you're using over here. So one, in Sharpe ratio, I'm taking sigma as the measure of risk. I'm assuming that sigma is the correct measure of risk. I'm assuming standard deviation represents risk correctly, and I've already understood there are so many other risks which have not been incorporated properly. And more than that, I'm assuming only standard deviation over here. I am not considering the negative skewness, private equity and all these. They will be very skewed and very high kurtosis kind of distribution, because let's say 90% startups fail in the first 3 years of its inception. There could be certain startups which would be giving excessive amount of positive return, but a good chunk, a good volume of number of startups will be failing. There will be few which will be giving extraordinary positive returns. Hedge funds also extremely high or extremely low returns, extreme high or extreme low returns. Kurtosis will be high, skewness will be high and could be negative. So how can standard deviation be a good measure? So this is a problem. So when you're using a Sharpe ratio, see, understand, it's not that you will not use Sharpe ratio. We will be using Sharpe, we will be using Traynor, we will be using variety of ratios, and each ratio is going to give me some indication. Sharpe will tell me, okay, this one, this is the thing. Traynor will tell me something else. Calmar is going to be telling me something else. So it's not that one ratio is good, one ratio is bad, you don't calculate the other. We in fact end up calculating all the ratios, and we analyze the ratios. We try to understand why is Sharpe so high or why is Traynor so low. So we try to see the discrepancy between the ratios as well. Tell me, are you following this? Getting the idea? So when I'm looking at the performance measures, so Sharpe ratio, excess return per unit risk, the risk being represented by standard deviation, which is not a very good measure of risk, because in alternate investments particularly, equity returns may be more or less normally distributed, but when you're looking at hedge funds, private equity, real estate, etc., they do not exhibit normality. They're rather skewed and have high kurtosis. So SD may not be the proper measure over here. Also, when I'm calculating the Sharpe ratio of the PE fund over here, let's say, I am not considering the correlation. The objective over here is that the Sharpe ratio of the portfolio as a whole. My ultimate objective is when I take equity, fixed income, alternate, everything together, then what is my Sharpe ratio? But here I'm trying to evaluate PE fund separately, a hedge fund separately. So you have to look at the correlation, the low correlation that these asset classes have with the traditional investments, equity, bond and all, right? Another problem is, we've discussed this, I'm not going to do the same example again. In downside deviation, I'd given that example over there, that a manager who generates good returns and at times very high returns gets penalized for standard deviation. When I'm calculating standard deviation, let's say, whether you have extraordinary negative or whether you have extraordinary positive, both are going to increase standard deviation. A manager earning 2% extra and another manager earning 2 and suddenly he earns 4%, 2, another 4%, 5%. Let's say the manager is earning extra. Still, this manager's standard deviation is more than this manager's standard deviation. I'm just revising this. I'm not doing the example. I've done this when I taught you downside deviation. So we should not be penalizing the manager for earning extraordinary high returns. We should be rather penalizing him for extraordinary negative returns. So therefore we make an adjustment to the Sharpe ratio, and instead of using standard deviation, we use downside deviation over here, so as to not disadvantage a fund manager or a manager or a asset manager or a multi-investor or someone who is generating extraordinary high returns. We want to calculate deviations only for the downside. I'm assuming like RF to be the benchmark over here. Tell me, are you following this? So RP minus RF by downside deviation converts Sharpe ratio into Sortino. So focus on the numerator, on the denominator. Focus on the denominator. It's always a return aspect by the risk aspect. All the ratios higher the better. Every single ratio higher the better. Downside deviation is already covered earlier. Traynor's ratio is a part of portfolio. Traynor's ratio, instead of calculating on sigma, we calculate it on beta. This incorporates the correlation because beta is the sensitivity towards the market risk. So over here it's considering correlation. It's talking about the risk measure in context of the whole portfolio. It's assuming that all the unsystematic risk has been diversified away. So what is the systematic risk component that you have taken? Traynor, although I don't use Traynor so much when I'm looking at an alternate investment part, because alternate investment class is supposed to be separately studied, as in you cannot look at the market systematic factors so well over here when you're looking at alternate investment. I'd rather do a Sharpe ratio of PE fund separately and then also look at the impact. Like if suppose I have a portfolio equity fixed income, then what is a Sharpe? Equity fixed income plus alternate investments, then what is a Sharpe ratio? I will try to see it that way, that how much is the return increasing or decreasing and how much is the risk increasing or decreasing. The return may not increase too much, but the risk has to decrease too much if the diversification is justified. So basically what I would want to do is, I will try to calculate Sharpe of equity plus fixed, that is traditional, and then I would want to see how my Sharpe ratio is changing. Because Traynor's ratio is more applicable when you're looking at the equity markets and all. So that is how I would want to compare when I'm looking at it from a practical point of view. Tell me following? But you can obviously apply Traynor's ratio over here. That is, what is the excess return your PE fund, hedge fund, whatever asset class is generating with respect to systematic risk, with respect to beta, not the total risk, but only the systematic risk component. I could want to look at the ratio that way. So Sharpe ratio, Sortino ratio, Traynor's ratio. This is a relatively new measure. This you have not studied in any other subject. I'm not sure if Sortino is covered somewhere else in level 1. I'm just not sure. I don't remember. Level 2, I think it's there in marketing management or somewhere. Anyway, so when I'm looking at Calmar ratio. So when I'm looking at Calmar ratio, it's very simple. Downside, maximum drawdown, you already know, we've discussed that. Maximum drawdown, the highest to the lowest value, the maximum possible loss an investor can make. The highest peak minus the lowest trough, the difference between that is maximum drawdown. It's a good measure of risk, particularly when I'm looking at PE fund, hedge fund, etc., which is structured in that fund kind of way, an 8-year, 9-year, 10-year kind of fund, wherein I want to see what is the maximum loss that is possible. And in the numerator, instead of excess return, we have the average annual compounded return. So if you have an investment over 5-year period, you can calculate the 5-year average return, and that obviously the return X% per annum compounded annually. X% per annum. So if you've generated, let's say, a 40% return in 4 years, the average compounded annual return could be somewhere close to, let's say, 9%, 8% or so. 40% in 4 years, 10% average, but then if you're looking at the compounding aspect, it will be little less than 10. So that 9-point-something% return I've generated per annum, that divided by the maximum drawdown, that is the return you've generated per annum on the maximum drawdown. This is just a ratio that you'll have to learn, nothing else. You'll have to learn this ratio. 1 second. You'll have to learn this ratio. I've not skipped anything. We don't have calculations right now over here. You've already done the calculation of Sharpe and Traynor and everything in the respective chapters. But obviously you need to know the formula. Calmar ratio, average annual compounded return divided by maximum drawdown. And we've already covered this part multiple times actually, that correlation in stress periods tends to increase. We already know this. And because of the smoothing aspect, when you're using those appraisal based index or something for real estate and hedge funds and all of that, model based calculations and all, sigma and correlation gets understated. And obviously if sigma and correlation is understated, these ratios will also be biased. That is why we are trying, we've repeated this point. Because if sigma and correlation is understated, in that case, these ratios, these calculations also become biased. So you have to be careful about it. You'll have to remember these things. Because ultimately you're using your sigma correlations, etc., to do the calculation for these ratios. Tell me, the ratios are easy, very easy. Revise properly everything that you've studied before, please. Then there are two other points that we are going to notice. Money multiple is covered in a very, very rough measure. It is going to be covered in detail later when you study alternate investments in more detail. So this is a basic ratio. Let me just give you some numbers. Suppose I have 100 million invested capital. The P fund has already generated a return and returned $125 million. So say for example I invested 100 million in a P fund. P fund made 5 VC and LBO investments. It has generated 125 million profit and already given it to me. This I have already received. I am the LP, I am the partner, investor in the PE fund. It still has got 2-3 small companies left to sell off. The value of those 2-3 companies is, let's say, 15 million. So in that case, basically the fund is 125 I already have received. 15 is the worth of companies, more or less the worth of companies that I am yet to receive. It will get liquidated, P fund will get the money, then it will pass on. And this I have generated on an investment of 100 million. This is 140 by 100, which is equal to 1.4. Basically this tells you for every $1 invested, you have multiplied your $1 and it has become $1.4 today. 1.4 is a money multiple. Every $1 you multiplied it into 1.4. Of course, out of 1.4, 1.25 is already in your pocket received and 0.15 is yet to be received. It is yet to be liquidated and provided to you. So multiple of invested capital, money multiple, we are calculating the multiple of invested capital. What is the amount of capital paid, capital invested till now? 100 million. Total capital already returned to you, 125. And value of remaining assets, 15 million yet to be liquidated. So a total of 140 by 100. Your money multiple is 1.4. You've converted every $1 investment into 1.4 times. You've converted every $1 investment into 1.4 times. That is what you've done. This is money multiple. Simple, easy. Of course, it's a major disadvantage. You've converted 1 to 1.4 in 2 years or 3 years or 4 years. There is no consideration to time value of money. There is absolutely no consideration to time value of money. You took 2 years to convert this, or 5 years or 10 years. Of course, it is going to be very important. In 2 years, great, please take me also into this investment. In 10 years, extremely bad. Itna to FD de deta. In 10 years, it might be very bad, but in 2 years, it might be a very good idea. But the money multiple approach is ignoring the time value of money. When you study these measures into details, we'll split this part separately and this part separately. Residual value paid in capital, etc. This is the residual value part, which is not yet returned. This is the return part, which has been already returned to you. Ultimately, we're just saying that for every $1 invested, what has it become? Part of it in the form of capital already returned, part of it yet to be returned. So in total, what has it become? Total paid in capital. We'll study these things later. Right now, just understand this much example. Right now, just understand this much. And IRR, we already understand, internally generated rate of return. IRR, NPV, you understand absolutely very comfortably. We understand and we remember the IRR disadvantages also. That in case of IRR, we assume that all the generated cash flows, all the intermediate cash flows are reinvested at IRR itself. We'll have to revise IRR very well. It's a very important concept in finance. Alright, let me explain IRR. Let me explain from the context of Altai first properly. So when you're looking at investments, particularly, I'm not going to be looking at IRR and all so much in the form of, for investments into gold, etc. Even real estate and all, it will be relatively easier for me to calculate. But particularly when I'm looking at PE fund, hedge funds, etc. Where you have your capital drawdown happening for 2 years, 3 years, you've committed a capital of 20 million. They've asked you 3 million today, 4 million next year, 1 million next year. So you're contributing capital. Then couple of years, the investment, the return that you're generating might be very low because it takes time for these companies to mature and provide return. You cannot have a unicorn every day, right? You'll have to invest in startups. It'll take time for the companies to use that money, grow operationally, leveraged buyout to, take a loan, take the company private, revamp the company, launch it again back to the public. So it takes time. These things are going to be taking time. So that is what we are discussing over here. So generally we might also have unconventional cash flow patterns. Most importantly, generally we'll still be having more of investments in the beginning years and then your recoveries. But generally you'll be having outflows in the first few years. More of smaller inflows in the middle part, in the couple of years, 2-3 years. So few years outflows, year 3, 4, 5, 6, maybe a little bit of inflow. Year 5, 6, 7, 8 onwards, you might be getting a lot of outflow. As in, you will be getting inflow, not from the fund point of view. You will be generating a lot of money. You'll be getting a lot of money. So magnitude, timing of cash flows become very important. It's not like you invested at time 0 and you'll be getting an annuity for 10 years and 10 years you'll get a big payment and all. It is not like that. It's not like you invest at time 0, you pay an EMI over the years, an equal monthly installment or equal annual installment, and then you get a bulk payment at the end of year 10. It's not happening like that. You might have a major investment at year 1, year 2 another big investment, year 3 maybe a smaller investment, 4, 5, 6 you're getting very small amount of money, then you suddenly get a lot of money, or maybe in year 6 you get a lot of money because maybe one VC became very successful. So there is a lot of, it's very erratic. The cash flows become important. The timing becomes important also because you have a 10-year kind of horizon, 8-year, 9-year, 10-year, 12-year kind of horizon. So these things become very important, and hence IRR becomes one of the most important measures when you're looking at it because of the timing and magnitude of cash flows being considered over here. Unconventional cash flow pattern could happen, but I'm not saying exactly unconventional. Unconventional cash flow means minuses, then plus cash flows, then minus cash flows, then plus cash flow. Not exactly that, but I would expect more of big minus cash flows, small plus cash flows, and then big plus cash flows. That is how I would be looking at when I'm looking at funds and all in the alternate investment part. In real estate and all, you might be having huge investments required in order to revamp, in order to refurbish the property and all, and then you will be able to start generating rental income and all. So even within the alternate investment classes, it's going to be quite different, the kind of cash flow pattern that each of these sub-asset classes are going to be providing you within the Altai part. Right, so this becomes very important that you look at Altai. So of course the major disadvantage of this was TVM when you're looking at money multiple, and the major advantage of the cash flow pattern, the IRR method of calculation is going to be that you're going to be using the magnitude and timing is going to be both included properly over here. Unconventional, you can remove that word if you want, but I'll let it be. So I'm looking at more of a cash flow pattern where it's a huge minus, small minuses, and maybe a very tiny plus, then a bigger plus, then a bigger plus, and then big cash flows. You can have maybe a couple of minuses over here, maybe a little extra investment is required or so. Maybe may not be, but generally that is what we're looking at. Huge investments, smaller investments, then smaller inflows, and then larger inflows as you liquidate. And maybe again a smaller pluses. Just a small couple of companies and all you're not able to sell properly, or maybe those sold at a lower valuation. First, you will try to recover as much as possible from the best performing investments, your best performing portfolio companies, etc. Tell me, comfortable with this? So IRR seems to be one of the best methods. Not that I'm not going to calculate a Sharpe, I'm still going to calculate Sharpe, Sortino, Traynor, Calmar. Traynor may not be so much, but still I would want to see at least how it looks like, and the money multiples and all as well, because everything is, every measure is going to give me another indication, another way of looking at my return and analysis, in terms of magnitude timing, in terms of how much money am I making in what time frame. I converted 1 becomes 1.4 when I'm looking at on a per unit risk basis, per unit systematic risk basis, per unit maximum drawdown risk basis, different ways of looking at risk, because my returns are not normal, so I cannot just stick to Sharpe ratio and all. So there are various ways in which I'm going to be calculating my performance measures. Tell me, are you comfortable till here? Good. So these are the various performance measures. Sums not right now, but still you need to know all the formulas, and anyways you have Sharpe and etc. sums in other chapters. So this completes your alternate investments, this part, performance appraisal.